The composure of the market and the shutdown lingo. We are in day 3 and it certainly has shifted. Joining me from the floor of the CME Group is Eurobond trader Russ Greenspan. Russ, give us a different perspective. Let's not just talk equities and macro. What are you guys hearing in the pits?
Well, in this stir market, that's eurodollars, we're not really hearing that much. The market doesn't seem very concerned by the shutdown so far. It's almost like a validation of the belief that QE was going to go on much longer than it was anticipated just a couple weeks ago. So we're seeing follow through now to the upside. Yesterday we saw the 30-year make new highs for the week. Just about half hour ago we saw the 5-year make new highs. So there's a bid underneath the interest rate market right now, and that's mainly the market's belief that the shutdown is now causing the economy to deteriorate further, which we were seeing before the Fed said no taper. And there's just not a lot of volatility that we're experiencing that we're saying, oh my gosh, this is shutdown related.
Right. Well, for your particular asset class, but if you take a look at the way the market is today versus the way it was on Monday, where the market essentially shrugged it off, the composure is certainly different right now. Because on Monday, everyone was thinking, and we saw it even on Tuesday too, how the futures were bid up huge into the close, that if we continue to get this shutdown, it's certainly going to allow the FOMC to continue tapering. But today, it really feels different.
Yeah, I agree. You see that the equity markets have gotten pretty skittish, and that has to do with now this creeping in realization that the recovery was not as strong as previously believed, and now is facing this headwind in the shutdown. And so you're seeing sort of people hedging up, and we've even seen in the front of the eurodollar curve some downside hedging that perhaps if this goes on longer than expected, or as we get closer to the debt ceiling, which really seems to be the real concern for interest rate markets, that we could see some volatility as the quote default risk for the U.S. Increases.
Okay, so finally, what is it that you guys are looking to hear? What do you need to hear from the debt ceiling lingo to either feel positive or negative about the market?
For the debt ceiling, what do we need to hear?
I mean, it's essentially in place anyway because Congress has already authorized it.
Right. So we just expect more can kicking. I mean, there doesn't seem to be a very real fear that the U.S. could default. It's almost like a political football that keeps getting kicked down the field. And so the markets, like as you said, they're just kind of shrugging off that risk right now. And we're seeing the rate complex, short term and long term, follow through to the upside. So, and that means that yields are declining.
Okay, excellent. Thanks, Russ. We look forward to catching up with you in a few weeks.
Thank you.
For more of Jill Malandrino's plays for trading spikes in market activity, visit optionsprofits.com.